What did we get to today?
We kicked off talking about Twitter's usage rates in decline.
And then we discussed Answerada's AI-powered data room and the new features they're bringing in.
And where we see AI going generally and how we're thinking about some of the support tools.
Then we talked about Tritium and some of their news out of the US, where they're under a bit of pressure, it seems, to maybe relocate headquarters from Australia to the US and shut down their Australian manufacturing plant.
And we watched a really good clip from the founder of Invidia and discussed our thoughts on the journey of being a founder.
Yeah, despite his $40 billion of net worth, he says it's not worth it. So that...
But it did segue into a good conversation about how hard it is being a founder, how difficult the journey is, not just in the short term getting off the ground, but longer term, and even how hard it is being a shareholder, with some news around a shareholder taking one of his portfolio companies to court.
That's Adir Shiffman and the sleeping duck court case, which seems to be dragging out.
Which then led into a conversation around founding teams and whether co-founders do indeed need a technical co-founder in order to secure investment.
Yeah, and then we ended with, if they get it right and everything goes well, shareholders and founders find themselves into rich lists. And with the young rich list out this week, shared a few ideas on whether they're good or full of shit.
So all up a pretty interesting conversation going all over the shop.
Great, let's get into it.
Sweet.
How are we, fella? I wish I was the same. Some things come back from kindy, so 4 days out from the old man doing Noosa Triathlon and hoping to get a PB. I've been hit with something, so that's making me look and feel old, but
well,
we shall continue on.
I'm hoping it's not COVID for you, because that is definitely doing the rounds, and I'm very grateful to be coming out of the tail end of that.
I don't think it's COVID. It's just throat, headache, and some other things that the viewers and listeners don't need to engage in. What have you been up to, Jack?
I've been in Adelaide, spent the weekend in Adelaide. I'm just with friends and family. It was a quiet weekend. I think the holidays are starting to catch up with me. I've also got a bit of a cold.
Oh, aren't we just falling apart? Aren't we just a happy group?
Aaron's on the up. He's recovered.
I thought I was home and clear until yesterday. I did a run, went for a fast pace, and that destroyed me again. And then last night I crashed early. So it's amazing, actually, post-COVID, how much it takes your breath. Just the sensation of breathlessness I still have.
Yeah, I think there is this definite thing of long COVID compared to what other viruses do to you.
I'd rather go with that than the fact that I'm just aging. Some other causality.
No, we don't need to be that aggressive and go down there. But yeah, it's been a good week. We're working on a really interesting deal at the moment with a short time frame that we'll be shooting out to our accredited investors hopefully by Monday. But that's exciting. Jack's doing a lot of the grunt work there. Thank you, Jack.
Yes, thanks, Jack. Looking forward to a site visit with them this week as well.
Yes, nothing like things that grow from $500,000 to $3 million to $8 million in a few years, and with a really strong growth projection and a global opportunity. So that's cool.
Yeah, very exciting. And then outside of that, there's been a lot happening in the news too. But Jack, before we get to that, I do have to just touch on the Wallabies. I know you're back from the World Cup and maybe trying to put the Wallabies behind you, but it seems they've made the news again.
Oh.
And I know you're passionate about following them, mate.
Yeah, I know we've got a lot to discuss today, but I think that was even something we could have brought up. Talk about trust and respect. There's no respect, no trust there now in the relationship. Eddie's gone. It's an absolute shit show.
Yeah. And he, as we said in a previous one, he came in with a really difficult job, and I think he did his best to try and be as positive and energetic as possible, but often sometimes it's not the what, it's the how, and I'm not sure he covered himself in glory there.
Yeah, but even just touching back on, like, you like to go back to trust and respect on. As a coach, it's very similar to being a CEO, and he lost the trust of the board and of the fans. And ultimately he resigned, but it's crazy. Like, it's the high performance game is cutthroat.
Yeah. Everything in life, it's common patterns, irrelevant of the environment, the same patterns, whether it's sport or business or family or relationships, those common patterns cut deep.
Yeah, it'd probably be fair to say in the life cycles of the Wallabies' performance in that recrimination phase, probably. Be interesting to see who steps up next.
They need a rebirth.
Yeah, totally.
Yeah. Let's jump into the news. Shall
Yeah,
we jump
let's
into some
dive in.
news?
I think we should pick on our favorite entrepreneur first. And we saw some Twitter usage stats come through this week. There was a chart which I don't know if we're able to share on here, but I'm sure Don could potentially add in later.
Yeah, I'll put it on.
Great. But it was just showing the usage plummeting for X, particularly in the mobile app, since October last year. So it's down 57% from October last year through to September this year.
I don't remember the last time I logged into it.
Really?
I go back into it every couple of days. I maybe go in for 5 seconds and I'm like, nah.
But
is that because the algorithm? Like, is that because you're not being served content
yeah,
that
like
you?
the people that I follow, I almost never see, and it's taken over by a lot of stuff that I don't, even when you select on the following one. And it just seems to be really quite weird. And then a lot of the people that I did follow, they're not very active anymore. So much of this social space in our industry, at least, has moved to LinkedIn. That's just where it's at.
Yeah, totally. I did a post in there last week and had 0 engagement.
I didn't. Oh.
Look, it could be a reflection of me and my personality, but compared to the engagement I used to get on Twitter, it's just crickets now.
I think the problem is it's a self-fulfilling prophecy. Their algorithm, if you don't post, won't serve, and so you then don't go back. But I'm just logging in, Aaron. Let me have a look here. All right, so you posted the last potty, and that's the interesting thing, right? You've got 5,800 followers on Twitter.
Yep.
And it was viewed 100 times.
Yeah.
So,
Yep.
and I guess the algorithms, if you don't get any early engagement or if you haven't been engaging, it isn't going to serve it. But then you end up with this self-fulfilling prophecy of what's the point? Because when we post stuff on LinkedIn, we're getting a lot more engagement.
Yeah, so I have a similar connection base, maybe a bit higher, or actually probably reasonably higher on LinkedIn, but the engagement number is phenomenally higher. So minimum engagement on a LinkedIn post, or minimum views on a LinkedIn post would be circa 300, but most are in the clocking over 1,000.
Time and time again,
very different.
Elon demonstrates that he's incredibly clever in some verticals, but also incredibly dumb in others. And Twitter absolutely had a revenue problem when he bought it, but it didn't have an engagement problem. But the changes, his behavior, all of those things has led to that, which sort of dovetails into another article that came out that was on Capital Brief, that some internal documents that some people got down, some internal documents that people had access to, shows that the internal valuation of Twitter is down 55%. So it's down to 19 billion from 44 billion, which I guess for his net worth is a bit of a rounding error. But these are the things in the traditional pattern that happens with this style of entrepreneur. These are the mistakes that sort of can cost them dearly.
Yeah, the other 2 interesting stats I picked up from that article, the headcount drop, which we all know, but that's 80% of the staff have been let go since he took over. But also his push on revenue, yet advertising revenues are down 60% since he took over. So
yeah, and I think the
lack of
staff
engagement.
Yeah, the staff one's interesting because for the prior 10 years, you had a whole ecosystem built on resources, raise more capital, just throw money at it, more people. But I think a lot of the world lost focus on resourcefulness, and out of necessity, he was one of the first that came in and just cut a lot of fat. The problem is that he also cut into muscle. And if you want to lose weight, the easiest way to lose weight is to cut off a leg, jump on the scales and go, ta-da, I've now lost the 20 kilos that I wanted to lose. And so you've ticked that metric, but what are you going to do now?
Yeah.
You can't run anywhere. You've lost that core function. And I think it went too far. A lot of the core functions was effectively cutting into muscle. And now he's dealing with the consequence of a platform that's becoming less used, less relevant. And I think there's 20 billion worth of debt sitting with the banks that they have to deal with. And just the consequences, it's that saying, And we're not there yet, but the dildo of consequence rarely arrives lubed.
For listeners, we'll put a link in the show notes for you to have that on a T-shirt that you can buy. Donisms.
Maybe that'll have to be edited. I'm not sure. We'll have to discuss. But the reality is, we see it time and time again that the entrepreneurial personality and energy, that the strength that builds these great businesses, when a strength is overplayed, it becomes an incredible weakness. And when you look at historical falls of grace, it's these kinds of decisions that are on the path. And when you then have to end up in a debt position, and when a lot of your net wealth is tied up in certain equity positions that can evaporate very quickly, especially if you've got margin facilities, this is danger Will Robinson territory, in my experience.
Yeah, absolutely. And there was another article this week about AI being used in M&A and the investment world. And it made me think, I wonder what an AI algorithm would have made of Musk acquiring Twitter, and what the AI algorithms would have predicted for the success or otherwise of X at that time.
Yeah, and would he have listened? Because the big issue was that he effectively waltzed in, essentially, it's like cash unconditional during an incredible period of time of upheaval, if you remember what was happening. And I've got to believe that he ignored advice, because then he then wanted to get out of it. And there were some cartoonish, clown-like arguments, if you recall, of how he was going to try and wriggle. Whether it's a human or AI, when entrepreneurs want to ignore advice, we've got a little bit of a problem. But notwithstanding, that article was talking about Sam Riley, CEO of ASX-listed Ansarada Group, which provides data rooms that we often see with companies raising.
Yeah, so we often use or end up in Ansarada with various data rooms, but interesting that they're starting to use these AI algorithms to predict. I think from my read of it was predicting the investor or corporate interaction with the data room to predict whether a transaction was likely, which of itself is super interesting. But
yeah, so it basically, the way I read it, Aaron, is it basically gives the seller an indication of which buyers are most interested. And it does make sense, right? Like, you're tracking who's spending the most time in the data room, so you can allocate your time to them.
Yeah.
Yeah.
And that's where I struggle a little bit, because to me, that's just a normal algorithm that's always been available for a programmer to track the data habits of people inside these places. I don't fully understand how we now call this AI. It's here's all the interactions, like even with a CRM, right? You just have a score, and it tells you who's most active on your email, your website, and based on that lead score, those are the people you should go and talk to. I wouldn't call that AI, but maybe the AI is going in and asking the questions or something. I don't know.
No, we see this a lot, but things that are labeled AI, but they're essentially like an algorithm. They're essentially just data that's being interpreted. But what would be interesting here is if it is actually learning from the interactions and learning from the transactions as to what interactions matter, then I guess that's a more meaningful insight.
Yeah, machine learning aspect of it.
This is part of that broader narrative we're seeing, that there's a lot of talk of the future of VC in a world of AI, where you could potentially run algorithms over data rooms and all sorts of behavioral patterns of the entrepreneurs and market analysis to predict the future success of companies, for example. And it is definitely something, we've talked about it. We obviously need to be aware of it. But at the same time, part of VC is that success is often found in holding a contrarian view. And I wonder how much this is almost reinforcing a set of behaviors. Do we end up behaving more in a certain way because the algorithms are telling us to behave in that way, and we all end up normalized? I'm just wondering if we're ruling out the outliers in that process. I don't know the answer, but it's just something I think about.
Yeah, with some of the stuff we've been looking at behind the scenes to our own AI journey, for me, it's how do you speed up some of the more mundane aspects, but how do you find stuff, especially in DD, either you couldn't find using a human approach or would take so long, that amount of time just isn't available during the process. So for me, it's some of that aspect. And you're right, we've got to be contrarian, but we've also got to be right. And it's about probably still serving up a series of data points, a series of information, things to consider that we then still have to overlay some patterns, experience, trends, those kinds of things. So that's where I see it going. And ultimately, for some parts of the market, I can see AI replacing some investment analysis, or even really early stage. I can see it getting to a point of view where there is a tool to help you pick an early stage portfolio. And that's more the traditional angel investing approach, where it gives some factors or some criteria that you weight differently and decide to throw a bit of money in on a portfolio approach. And then the venture side of it really comes during that scale up period of being able to say, okay, there's some product market fit here. Now we've got to scale. But I still think ultimately it's going to be smart people supported by AI tools. It's not going to be AI alone.
Yeah, no, I agree. And I think that the three short-term opportunities, one around what other data can be introduced, to overlay analysis. Second, around benchmarking. And I think, to your point, I think the D process, AI in the D process, will be super interesting at picking up things that we potentially could miss, but also getting some insights and modeling that could be really advantageous.
Yeah, I think where we're heading, we're going to have our closed AI models. There's going to be data sets, just simple things like, okay, for this company, where does it live against all of these benchmarks that we know are important when it comes to deploying capital, in terms of, is it scalable? Is it capital efficient? Like, that is us, though, just using a tool to quickly answer a question that goes into our investment process. Where it'll end up is Jack's just going to have all these little AI tools.
And can you imagine, Dom, what you're saying there? The company's hooked up to a analytics platform like SaaSgrid, and it's got all of the benchmarks we track, and then it's just connected through like the plugins, and it's got your sales force, everything's plugged in. So then the AI model's running all the calculations for you, looking at it.
And this is where deal flow will get really interesting, because there will be something that emerges that companies can just plug into, and then it's going to be lead gen and deal flow for VCs that VCs and investors are going to end up paying for in order to get access to those early companies. So that's the way I see it heading. Now, to Aaron's point before, making sure that we don't end up in a world where only inevitable winners are backed, and that we lose that creativity that comes from things that don't work out. When you look at the tech booms, when you look at big investment booms, there are things that don't work in the moment, but give birth to the future opportunities of something else. And so from an innovation point of view, making sure we don't end up in that world, because that starts to become very narrow.
Yeah, it's really interesting. Andre Sherbin, based out of Sydney, he, as an investor, had an SDK that startups could put into their software stack, and it would basically almost send off an alert when certain key metrics on the actual user and engagement side of the product were hit. And then Andre would reach out for a potential call around investment. We should actually, I'm going to reach out to Andre, get him onto a podcast and see how that played out and where he's at with it.
Yeah. No, that sounds, look at that, real time on.
Andre, if you're listening, I'm going to message you.
But if we had the AI connected, it would have already sent Andre, it would have already established if it has been successful, is it a good idea, and whether we should spend our time or not.
Even better, it would have read our show notes in preparation for this podcast, already predicted that I would have thought of Andre and already have sent him an invite.
That's where we're heading. I think it probably would have first made an assessment. These aren't show notes. These are the random scrawls of a few idiots.
At what point does AI just leave the building and go, I'm done, fellas?
I'm out.
I guess it's one thing to use AI to pick winners. Then it's another for portfolio companies to go on and have wins. And then it's another for them to stay as winners long term, because these things, entrepreneurship is never easy. It doesn't seem to get any easier despite successes.
Sustaining is such a key part.
Absolutely. Which segues into Tritium and some news this week about, I guess this was, for context, Tritium was is one of the darling stories out of Brisbane. One of our great success stories, listed on the NASDAQ. I can't actually remember the year they listed over there. It wasn't that long ago.
But April 2021.
April 1st, 2021. So it was right in the peak mania.
The news this week is they've been issued a show cause notice last week for underperformance.
Yeah, so the share price, it looks like they listed it about $9.62, around $10, and it managed to stay there all the way through till early 22 when the whole industry blew up, and now it's down 97.92% to 20 cents, which would be a little bit painful.
Yeah, and so the reported gross margins at negative 2% for 22-23. So clearly got a cost issue there. That margin has come back, so it's at 4% at the moment. It is an interesting one. A company that grew out of Australia, expanded into the US, but my understanding is kept its headquarters here in Brisbane.
And that was some of the article talks about. It's an American listed company, but they're trying to run it out of Brisbane, and therein lies the problem. And they don't go on to explain their view of why that is a problem, but I just assume it's timing, resourcing, focus, energy, that at a certain point, once a company's operations gets to a certain scale, being on the ground there is probably the way to go. But I don't know enough about this story in order to make a comment.
No, same. It's just interesting that they seem to be under pressure to close down the Australian manufacturing plant and shift headquarters. But it is one I wish I was closer to know exactly what's going on. But
the article says that Tritium's major cornerstone shareholder and non-executive director, Trevor St. Barker, criticised the lack of Australian government support for the company despite numerous photo opportunities that federal and state politicians have seized on the champion Australian engineering and job creation in manufacturing. The key shareholders are Trevor St. Baker and coal baron Brian Flannery. And this is the interesting thing about this space. So St. Baker's original 19% stake in the company was worth on paper about $3 million when it listed. It's now worth about $19 million, and he has pumped in money a couple of times, including another $35 million in March just gone. So from a market cap point of view, that stake is worth $19 million, and it looks like he's put in tens of millions of dollars, and that I'm sure hurts, but I think it's, I don't know.
Look, a good, by reputation, that the St. Baker family are great investors to have behind you. They're there for the long term. Yeah, it'd be an interesting one to watch, I think, going forward.
Yeah, absolutely. And the ups and downs, obviously this cycle, just with the COVID money and COVID interest rates from 2020 created this incredible updraft. But as we know, once gravity sets in, it tends to fall just as quickly, which is what's happened here. This is also not to this scale, but building companies is hard, right? Building a company is really hard, even if you hit a whole lot of success in the long term. In the short to medium term, it can feel incredibly painful, and I'm sure the Tritium people are juggling a whole range of issues. But one of the founders of Invidia was interviewed by the Acquired podcast.
Yep.
And we'll just play this now.
The Acquired boys are putting out some bangers. Can't believe they got Charlie Munger.
Yeah, I listened to that at 2:00 this morning.
99 years old.
Yeah.
What a weapon.
Oh, he's
absolute legend. Has that come up yet?
If you were magically 30 years old again today in 2023, and you were going to Denny's with your two best friends who are the two smartest people, and you're talking about starting a company, what are you talking about starting?
I wouldn't do it. I know. And the reason for that is really quite simple. Ignoring the company that we would start. First of all, I'm not exactly sure. The reason why I wouldn't do it, and it goes back to why it's so hard, is building a company and building Invidia turned out to have been a million times harder than I expected it to be. Any of us expected it to be. And at that time, if we realized the pain and suffering and just how vulnerable you're going to feel and the challenges that you're going to endure, the embarrassment and the shame and the list of all the things that go wrong, I don't think anybody would start a company. Nobody in their right mind would do it. And I think that's the superpower of an entrepreneur. They don't know how hard it is. And they only ask themselves, how hard can it be? And to this day, I trick my brain into thinking, how hard can it be? because you have to.
Still,
Yeah,
when you
to
wake
this
up in the
day.
morning.
Yep. How hard can it be? Everything that we're doing, how hard can it be? Omniverse, how hard can it be? It
I don't
turns
get
out
the
it's
sense,
super.
though, that you're planning to retire anytime soon, though.
No,
Like, you're
no,
still,
I'm still young. I'm still young.
You could choose to say, like, whoa, this is too hard.
The trick is still working.
The trick is still working.
No, I'm still enjoying myself immensely, and I'm adding a little bit of value, but that's really the trick of an entrepreneur. You have to get yourself to believe that it's not that hard, because it's way harder than you think. And so if I go taking all of my knowledge now and I go back and I said, I'm going to endure that whole journey again, I think it's too much. It is just too much.
So that's from a guy currently worth about $40 billion, putting the perspective of the journey, saying it's a bit hard. But I think he's right. Even with our journey, we keep finding interesting things that keep popping up, that if you knew everything that was ahead of you, you'd probably question your sanity. But the good thing is that you don't. And the good thing about the brain is that it tends to forget the bad and romanticize the good. And that's why people have multiple children.
You're speaking from some experience here, Don.
Probably more so my wife, but yeah.
Yeah. But he didn't even hesitate in that answer, right? Like
No.
it's a very clear, he's obviously given this some thought before. But those words of embarrassment and shame stood out from that for me. And I do have this, listening to that, I recognize I have this little thing in my head, which is, what's the worst that can happen? I do have this, I find comfort in what's the worst that can happen? Just keep going.
Yeah.
And it is interesting when others who are not entrepreneurial see what entrepreneurs do and the comments they say, like, they see the batshit craziness. But I think we ourselves don't necessarily see it, or at least we suppress it deep down.
I think
somewhere.
the opposite can be true sometimes. Absolutely. Embarrassment and shame has featured over my 20 years multiple times, but there were times where it was self-imposed embarrassment and shame that others didn't see the same way, or there were times sometimes where you should be embarrassed and shamed. But an interesting perspective. But I think the trick that he says there at the end is what you got to do. You got to keep saying, how hard can it be? And I saw a post, I think it was actually Jesse Wu who had posted about how do you go about finding or highlighting the most intelligent founders. And for me, you actually, and this is probably going to come off the right way, and I'm not going to describe it as what I'm trying to describe, but super intelligence is not actually a key to success here. I find people of incredible intelligence often trip over themselves, analyze and overthink, and they then just can't break through the barriers that less intelligent people like myself can trick themselves into suddenly just, it's like falling through the fence. Like it's everybody else is in there going, that fence is too high. There's all these reasons you shouldn't do it. Whereas somebody like me is running at it. It's like that scene out of that British movie, instead of running at it, but you trip over and you just smash through the fence. And you didn't mean to, but you used your thick skull to get through it.
It's interesting. I know the post you're talking about, that reference, and I had the same reaction. As intelligence might be a factor.
Yeah,
but
it depends on the definition. Again, the problem is how people use words but for me, yeah.
No, there's a couple of founders in particular that I'm not going to name, but absolutely to their credit, they were exceptionally good at asking everyone for help because they didn't know how to do it themselves, and went on to achieve success exactly because they were very good at rallying resources around them. And because they weren't of that nature of, I can work this out and do it myself.
Yeah, I know. I already know everything. I've got the answers.
On top of that, there's also the element of luck, good and bad luck. So you can have a really smart founder that can get some really bad luck.
Oh, totally. And that's what in the Charlie Munger episode, you need, I think he says intelligence, hard work, and luck. And in that interview he does with them, they ask him, could you create Hathaway again today? And he said, no way. We hit a stroke of luck early. Everybody needs that luck early. And they were able to create some momentum that just became bigger than themselves. But yeah, building it is hard. It's important to not know how hard it's going to be. It's important not to overthink, and it's important to have an incredibly thick skin where even if you feel that shame and embarrassment, you're able to push through. And when you look at really successful founders, there may be that feeling of embarrassment or shame or whatever, but the ones that can get out there and sell and that can handle rejection and can handle no's and can just keep like water off a duck's back, just keep going, they're the ones that are successful. They're the ones that just go, okay, that's a no, or I'm going into it knowing that 99% of the answers are going to be no, and I'm going to be okay with that. Like, it's actually some of those personality traits, and whether your body's reaction to rejection triggers a series of feelings that makes you want to either pause or give up, whereas some people's bodies don't trigger those reactions and they are able to do things that other people are not able to do.
Yeah, almost our reaction to the embarrassment and shame that the co-founder of Invidia talked about.
Yeah, you got to keep going. And for me, I learned, or have become better at learning, it's not you or them, it just is. And in the world that we live in, you just got to keep going. And if you genuinely believe in your product, if you think it's of value, if you think it's can help, then you just keep focusing on that and keep moving through.
Yep. And Michael Caine says, use the obstacle. I love that little video from him. I think the other thing here is it's not just hard for the founder, it's also hard as a shareholder, which segues into an article from Capital Brief, which we have talked about this story before on one of our podcasts.
Yeah, we talked about this on a previous one, but this story's by Bronwyn Clune and Lauren Henning, and they've been tracking the legal case of Adir Shiffman and Sleeping Duck, which seems to be dragging on much longer than anybody imagined. They're quoting legal costs in the millions. Now, legal costs in the millions must be there must be a prize at the end of this for either party worth many millions. So it's going to be interesting.
One would assume so, although not always necessarily true. But I think, yeah, what's interesting in this one, Shiffman acquired a 10% stake in the company for $100,000, had an option to acquire another 10% stake. He's arguing he didn't get that option and now is looking for that option to be executed or at least be compensated. And yeah, it doesn't sound like this is going to end anytime soon, given the dollars spent to date and the failed mediations and everything else.
Given the value of Sleeping Duck, I guess it's worth a fair bit, but it's being alleged that the founders had a side deal, a behind-the-scenes deal, that effectively when they implemented that screwed him out of that stake. And I've seen this a couple of times in the early stage investing scene where the relationship breaks down. Back to those earlier words of trust and respect. And once relationship breaks down, people feel entitled to behave in certain manner, even if it's not supported by the documentation. So I've seen a couple of times where once there wasn't that relationship anymore, then there were behaviors that led to certain things on both sides. And we will soon see what happens here. But if the founders and Adir were in a good place and there was a good relationship, things wouldn't be going down this path. But clearly that relationship broke down and here we are.
Yep.
I will say there's a bit of a red flag out of the article. One of the text messages that came out from Adir said, "Every day I'm not suing someone, I'm agitated. Where's my litigator?"
Yeah.
Again, we can't comment too much on that, but there's a bit of Clive Palmer-esque vibe.
Yeah, we all know these things can be taken out of context and we don't have the broader context.
Absolutely. Yeah, no, that is true. Context matters. And so we'll see where that comes. And one of the, ultimately they're fighting over value, but the value of private companies can be quite a black box. And even ourselves, there are a range of different methods. And we saw a valuation report this week for one of the companies that had done, and what were there? 11 different methods of valuation that the report looked at in order to triangulate what was fair and reasonable.
Yeah. So Schrodinger's cat, the concept that you can only know if the cat is alive or dead in the box if you actually open the box and look. And the analogy that startup valuations are similar in that they're only valued at an event which is often an investment round or an acquisition.
And I guess the analogy is that the cat, what they're saying is on the paradox before, is that the cat can therefore be viewed as both dead
and
at
alive.
that point.
Yeah.
Because we don't know. And the segue of that in this article was the startup could be worth a lot or worth nothing. And we don't know until we peel the box back.
Yeah, so the article touched on how most VC funds value their portfolio. But what was interesting was the comparison of valuations of private tech companies versus those in public markets. And the differential was actually quite significant. I hadn't seen this data before, but comparing for example, the data set in 2022, there were 806 private tech companies valued at greater than $1 billion based on their last round price, but only 278 similar tech companies in public markets, so of comparable value. So what it was highlighting was far fewer companies in public markets, tech companies, valued over $1 billion compared to those in the private markets. The other interesting factors were that they had some data in there showing that down rounds are continuing to go downwards. Valuations of down rounds, though, increasing on average. So that's average valuation of a down round. In other words, that the larger valuation companies are having down rounds. There was also similar trend in secondary markets. So secondary transactions had increased, but the price levels were 40%. So on average, secondary round valuations were 40% of the previous primary round before the secondary.
Yeah, one of the charts in the article is capital raised by VCs is at an all-time high, but this may be more damp than dry powder, which I thought was an interesting one. And what they're effectively saying is, yes, the VCs have raised a lot of funds, but there's this overhang from their 2021 and early 2022 vintage that is going to make it difficult for some of them, because in order, I think what they're partly saying is that until all of these startups that only raised in 2020, 2021 and early 22 have gone through a subsequent round or not, until then the valuations are not going to wash out through the industry.
And I think for us, the data is just validating what our thesis was for some time now and what we've been hearing from the UK and elsewhere.
Yeah, no, we're seeing companies that are growing more than 100% year on year, that from a multiple basis, sub 5. There is, I think one of our previous episodes, we talked about a valuation fall doesn't mean that there's been an investment fall, and there's still some really good quality stuff coming through.
Which, while we're talking about organizational strength, there was an article or a post on LinkedIn questioning, do you still need a technical founding team to raise capital from VCs?
Yeah,
it was an interesting point of reflection for us to think about the technical founders in our own portfolio.
On one of my early stage angel investments, 2 non-technical founders absolutely got themselves into a pickle, because not having any technical skills when small changes needed to be made meant they couldn't get product market fit quick enough, and then ran out of money in order to get some of the changes. And then because of themselves not having enough technical experience to understand the people that they were employing, whether they were doing the right thing, was the database design correct, was the coding structure correct, then Murphy's Law was there were some poor decisions made on behalf of those that they paid to do it, and that company then just didn't get the momentum that it needed. And in hindsight, had there been a technical co-founder that could have been smashing out the lines of code to make the little changes, that business could have been really quite successful. And so that angel early phase stuff, I think there's a lot of stuff that without a technical co-founder, it is just too risky. But on a lot of, because we're investing later stage, and by definition there is customers, by definition there are customers, they do have momentum, and a lot of that early stage validation has occurred. When we looked at our portfolio, there's a number of technical products that didn't have a technical co-founder, but they were able to bring together the resources and the people that, whilst they weren't co-founders, they were deep enough into the vision and mission to really perform that role, which allowed them to get momentum, which allowed them to build companies with millions of revenue without that traditional co-founder.
Yeah, I agree, Don. Most of the time, like we're looking at the pre-Series A, Series A stage, so that time they found product market fit. And the reason that most startups fail, it's because they never actually find product market fit. But when we look at them, we usually got a founder who has also made their CTO higher. So at that stage, it's mitigated.
And even with a technical founder, you still end up with technical debt. You still end up, have a look at Canva. They still talk about the pain of having to rebuild the platform. Luke, the pain of having to rebuild the platform. Adrian in the early days. Like, having a technical co-founder doesn't mean that you're going to get out of the building of an MVP that ultimately doesn't then scale into $1 billion business. Like, it's just not possible to build an app and a platform that's going to scale to $1 billion at day one. You're just never going to get that capital. So there's a rite of passage that you have to get to, but it's how quickly and how do you reduce the risk on that path there.
Yeah, what was interesting from this post, so this was a post by Jason Salt, and there was some data in there which cited 66% of unicorns had a technical, at least one co-founder with a technical background. But that also means that 34% of tech unicorns didn't have a technical co-founder.
And I think it's where you invest. Like, I would say Main Sequence Ventures with their deep tech, I'd be surprised if 90-something% of their businesses didn't have a technical co-founder, because their stuff is like really deep tech stuff.
Yeah, and I'd actually be curious in knowing that this data talks about unicorns, so it's measuring on that end. But I'd be curious to know, of companies that start, what proportion actually have a technical co-founder. I'd love to see the success rates through the life cycle, like through the stages and different funding rounds, because there is a common held belief by a lot of investors that you have to have a technical co-founder in the team or they won't invest. And this article actually, or this post actually referenced the fact that over the last 5 years, there's been a declining proportion of investment into, I think it was technical co-founded teams. So it is changing. But yeah, it's interesting. Why is that change happening?
Yeah, we chatted potentially from the no code becoming more accessible and things like that.
Yeah, and I think to the point before, where I know several founders who are not technical who've built and exited tech companies. And in those cases, what they did really well is like that mantra of outsource execution, but you can't outsource responsibility. Like, they upskilled in their understanding of technical stacks, of what is the right infrastructure layer that they need to be deploying, understanding their data schema,
themselves with experts.
Exactly. Yep, all those things. I think it is very doable, clearly, from the data. Yeah.
And if they get it right, and if investors get it right, and you find product market fit, and you build a really great business, you end up on the rich list.
Yes, the BRW top 10 richest young Australians recently released.
And I always have a chuckle at these lists. These lists are interesting from even a lead gen point of view, going out and having a look and who's ending up on these lists. But in my experience, a lot of these lists are total rubbish. And where I first learnt that was in 2011. That business, 2011, we won the Telstra Medium Business of the Year award. And in that, your revenue is released. We had started at, first year was 50,000 in revenue, then 350,000, then 8 million, then 20 million. Maybe it was 22 million. So good growth. We won that award. I remember that awards night because I forgot to thank the major sponsor of that award, which was Panasonic. And literally the guy came up and shirt fronted me. Like, you've got no idea how much we spend sponsoring these awards, and we didn't even get a thank you. And I was mortified. So then we won overall Business of the Year award. So I went back and thanked Panasonic, but then forgot to thank the sponsor of that award. But anyway, they didn't have some wanker in the chair. But anyway, I get this call one day from a BRW journo saying, we've seen you've won this award and we would like to enter you into this year's list. Now, at that time, like, I had moved into the house. I drove out to the farm to get an old mattress to put on the ground. I had a beanbag. I was I didn't have a lot of dollars, right? Everything was going into the business. I was driving my 10-year-old ute, and it was just, I'm like, what? Rich list is, if you're doing 22 million in revenue, a business like that normally is doing about 20% EBIT. So that's about 4 million. And if you were to sell it, you'd probably get, say, 10 times. That's 40 million. And I'm like, now I'd had the good fortune that some of my early investors, really great people that are incredibly wealthy, under the radar, and had always instilled, like my chairman would pick me up on his scooter in Sydney Airport, and we'd scooter to meetings, dodging. I still remember we'd go into investor meetings or different things, and I'd be on the back. It'd be like Dumb and Dumber. But these are people worth like real money. So there was just this culture. One guy drove this 20-year-old Magna that has his own island, like just really great, humble people. And we'd always talked about the perils of these kinds of things. And one of my competitors had gotten into the rich list and it had killed him. Like all of the clients started going, how much are you actually making out of us? So I had the good mentoring to say, look, I'm going to have to call you back. So I called one of them and said, look, this is what's happened. And my understanding is this is not a good idea. So their assumption was wrong. We weren't making 20%. We were making at that time, because we were ramping up, I think about 11%. And the last transaction that occurred in our industry was 6.5 times. So I called the guy back and said, what's the cutoff? And I think the cutoff was like 32 million or something. Actually, we're only making 11%. That's the number. Here's the last transaction. This times that doesn't meet that threshold. So I don't think I'm in. And I think he said something like, I think you're the only person that's talked yourself out of the rich list, which was incredibly good, because when I then had a massive fall from grace and fucked everything up and had to put things into administration, which is not something I'd suggest for anyone. I got some media coverage, but I didn't get a lot of the fall from grace stories that often happens with people that do that. And then another friend of mine who the story worked out, but at the time that they had put him in at 90 million, he was ready to trade the company for a can of beer because of the sheer amount of debt. Some people on this list will be real in terms of real hard dollars. Some of it is vapor money that if a few things don't go right, they disappear and then they wish they were never on it.
Yeah, it is a good reminder. It's a good point.
And for right now, it's a long way from ever having to worry about one of those phone calls again.
It is the young rich list. We've
By
dodged
the
a bullet.
time any carry in this game, because my wife keeps asking, so you do all this stuff and we don't know if it's going to work for a decade. And by then, and I'm like, the good thing is that my suggestion is to you, you can't divorce me for at least 10 years because you won't know. So I've at least extended the marriage.
Oh, I love it. I love it. We've covered a lot of ground. It's been a lot of news. And then there was heaps more we looked at this week, which could have made the news, and we'll
flick it to next
didn't
week.
quite make the cut. Yeah. What are we excited about, boys? What are we looking forward to?
Somehow I've got to pull my finger out and get rid of whatever virus I've got so I can then complete the triathlon as an aging, a mammal, a middle-aged man in Lycra. So I'm looking forward, and then I'll have Monday up there, and we're catching up with an investor and a potential portfolio company on Monday. So that's exciting up there. And then the week after that is the offsite. So still getting prepped for that, getting ready for that. And that's exciting. The group chat is going off, which I always enjoy, and do my best not to impulsively embarrass myself. I prefer to embarrass myself in person rather than before meeting people.
Face to face, not digital. There's evidence digitally. Good luck for the tri. Sorry, not marathon. Tri.
Is that on Saturday, Don?
Sunday. So if you don't hear from me Sunday night, you'll know that it hasn't worked out.
Jack, what are you looking forward to?
Just a quiet weekend. Looking forward to getting back to Queensland next week and catching up with you guys and heading to the offsite.
Yeah. I'm really looking forward to the offsite. That was most of my day yesterday doing some prep for that, and seeing the channel light up with all the participants is a lot of fun. So really looking forward to that. And then the other one for me is I have a lot of random catch-ups in the next few days with one founder who recently had his exit. So keen to hear how he's going. Another founder mate of mine from the US. I catch up with him on a call. So yeah, some random ecosystem connections coming back out. So it's good to touch base with them. And I think the other one for us is this deal that we're looking at and getting very excited about that. So
yeah,
keen to see that one through.
Absolutely. All right. Until next time.
Yes. See you then.